Hello, it's me. I was wondering if, after all these years, you'd like to meet, to go over everything. Yeah, scrap that, James Corden does it way better. Hi there guys, my name's Matt, I'm an economics graduate and accountant, currently living in Cheshire, and today I'm bringing you part 2 of the Introduction to Transaction Services Financial Due Diligence. Today we're focusing on net working capital. I'm going to try and give you a high-level overview of how financial due diligence is carried out on the target company's balance sheet, specifically focusing on net working capital and net working capital targets, looking at what that means and why it's relevant for us. In part 1, I've already covered the P&L and adjusted EBITDA side of things, which I will try and link somewhere around here. Never done that before, no idea where it goes. Failing that, it'll be down in the description. So when it comes to doing buy-side FDD, when you're looking at the target company's balance sheet, one of the first and most important things we're going to do is categorize all the different assets and liabilities into 3 different categories. They're either fixed assets, net working capital, or net debt / net cash. And we're going to do this rather than simply splitting the balance sheet between assets and liabilities, as you'd see on the face of the financial statements. For the purposes of this video, I'm not too worried about the fixed assets. This is unlikely to bring about material changes to the day one consideration, which is really where we're focusing. That said, we're still going to look at doing audit type procedures in this area, things like agreeing balances to fixed asset registers and reviewing the aging of plant and machinery to make sure we don't have any write-offs. I'm also not going to focus too closely on net debt and net cash today. That's going to form part 3 of the trilogy. The focus of today's video is going to be on net working capital, the reason being that depending on your lockbox or completion date, the value of this figure is going to have an impact on the day one consideration paid for the target business. So to kick things off, net working capital is really a measure of the target company's liquidity. It's the difference between its current assets less its current liabilities, excluding cash and debt. That assumption is made on the basis that businesses are typically valued on a cash-free, debt-free basis, which is almost certainly the case in my experience. So on a relatively simple transaction, we'd have our net working capital comprised of stock, trade debtors, other debtors and prepayments, trade creditors, other creditors and accruals, and then some tax liabilities, possibly VAT or payroll type taxes. And this is where we hit the crux of the issue from a net working capital perspective. A buyer will commonly expect the net working capital being transferred on completion to be as close as possible to what was assumed for the purposes of the financial model or the forecast from which the valuation they placed on the business was actually made. This figure that was assumed is going to typically be the business's average or underlying position. By its very nature, net working capital does fluctuate. It goes up and down based on the day-to-day operations of the business. It's this change in net working capital over time that is really key to impacting the total purchase price. So most sellers and buyers will typically agree to a purchase price adjustment based on a true-up of the actual net working capital position as at the completion date. And in really simple terms, what this true-up involves is adjusting the business's net working capital as at completion to bring it in line with an average underlying position for the business, which you might take based on the last 6 months or the last 12 months. The exact time frame used to calculate the average can vary depending on the nature of the business. If a business has grown a lot in recent months, then it might make more sense to use a shorter time frame to actually capture the business looking as close as it can to what it looks like today. If we're going to go back 12 months from that point, really we're going to be comparing today with a business that looked completely different a year ago. So as a result of this, the FDD process involves digging really deeply into each of the components of the business's net working capital with a view to identifying any unusual movements or one-off items in a similar way to we do for Adjusted EBITDA, as I talked about in my previous video. We're really trying to make sure that we remove the impact of any of these unusual items from the last 6 or 12 months of trading, so that we're left with the true underlying average position of the business in order to compare that to the position as at the completion or lockbox date. A good example of an item like this in the year just gone would be a business's VAT liability being inflated for a period of months across the summer of 2020 on the back of taking advantage of the government's VAT deferral scheme in light of COVID. In this instance, what we look to do is reduce the liability down to a more consistent position with what it would have actually been had the payment profile been consistent with previous years and what it will likely look like going forwards. In a lot of businesses, and certainly a lot of the businesses I've seen, the trade debtor balance is typically the largest individual component of the net working capital, and as a result this is probably the one that's scrutinised the most closely throughout the FDD process. We'd typically be looking to make adjustments to make sure that the trade debtor position we were left with only reflected accounts that we believe to be settled. We'd be stripping out any doubtful debts or any debts owed from companies that we now know to have gone bust, for example. In addition to this, we'd typically be excluding any balances from related parties or any intercompany trading for the purposes of our net working capital assessment. I find it way easier with this sort of thing to actually understand what's going on if I can see it happening. So I'm going to just run through a quick example using some actual numbers from a client we've recently dealt with to show how the process really works from start to finish, how we move from our actual position as at completion to a purchase price adjustment based on the average over the last 12 months in this case. So just to quickly run through an example to add a bit of colour to what we've just talked through. These are some numbers from a recent client of mine, and what we can see in this table is here we've got the reported net working capital position above what we've calculated as an adjusted position. The difference being these two adjustments, one in respect of a COVID related VAT deferral, the other a trade debtor overstatement whereby we think there may be some write-offs. So firstly we're going to consider this green column over here whereby we can see a net working capital position of 682 on a reported basis as at December 20 being the date of completion. And what we're going to do is say okay, I can see that's primarily driven by my trade debtors of 866 offset by a big trade creditors balance of 332. As I mentioned earlier, typically your trade debtors and trade creditors are going to be two of the largest components. In some businesses, stock will also be important, but in this case, possibly less so. So we're then going to overlay our two adjustments, VAT deferrals, which is going to reduce our VAT liability down on these lines here, and the trade debtor overstatement reduces our trade debtor balance across all of these lines here. We then add these through, an example being trade debtors of 944 as at March 20, a reduction of 50 reflecting possible unrecoverable debts, leading to a position of 894 on an adjusted basis. And then when we total that all up, we reach this green line across the bottom, which on an average basis across that 12-month period works out to be 630. And as we can see, this 630 is actually £52,000 lower than the 682 we're quoting up here at the top. And what that means in this instance is the actual net working capital position is in excess of the target, and the adjustment we'd make today on consideration as a result of this will be an additional £52,000 paid to the vendor. It's pretty important to note as well, it's not just the buy-side FDD work that's sort of the be-all and end-all. The sellers will typically have their own advisors coming up with their own net working capital targets. So whilst in the example we just talked about, it looked like a 52k increase to the purchase price, you might think, well, great, my FDD's not done me any favours there. But actually, if we thought that was the correct position to arrive at, and the seller's advisors thought a £100,000 uplift was more appropriate, then we can form the basis of a meaningful discussion. It's not uncommon for discussions and disputes to arise between the buyers and the sellers at this stage, because there is a relatively high level of subjectivity involved in the adjustments themselves. What the buyer might deem a doubtful debtor is arguably not so from the seller's perspective, or vice versa. And not only that, but the actual period over which we're taking the average from, whether that's 3, 6, 12 or 9 months, also makes a difference and will favour one party depending on which one's chosen. So I hope that adds a little bit of value to you guys. I know it was a little bit of a whistle-stop tour. Any questions or any further detail you want, feel free to drop me a note down below and I will certainly get back to you. Other than that, yeah, keep an eye out for part number 3, as I mentioned, where we'll look, well, like 4, part number 3, as I mentioned, where we'll touch on net cash and net debt and the impact that can have on your total purchase price. Probably run through another example there as well. But yeah, I think that's it. If you thought the video was any good today, guys, or the example was of use, then feel free to give me a like. Still trying to get the channel off the ground in my 3-month trial period, so still seeing how that goes. That's all from me though today, guys. All the best till next time. Stay safe. Bye bye.